declining interest rates or ultra low interest rates. People tend to say, well, that's what it's been for 40 years. That's normal. That's what it's going to be. But no.
An incredible financial opportunity has arrived, a chance that doesn't come around often. Right now, a significant change is unfolding in the financial world, and it's creating some of the best opportunities for everyone. It's a rare occasion that could reshape your financial journey. Time is of the essence, and this opportunity is tailored for your lifetime. In this video, we will explore these opportunities and principles for guiding investment. A once-in-a-lifetime opportunity has arrived. If you're familiar with Howard Mark, you will know that he's a big shot. He's a big deal, worth over $2 billion. Howard is the co-founder and co-chairman of Oaktree Capital, the largest investor in distressed securities globally. Oaktree deals with $164 billion for its customers, mostly in tricky financial situations. They're experts in handling money matters when things get a bit tough. The company, mainly working in the US, but also Europe and China, has some wise advice from Howard Mark, the legend behind it. Howard suggests a universal approach to decision-making about money. According to him, investors everywhere must follow a pattern of stability. Being a good investor means staying steady and not changing your mind all the time. Marx even suggests a specific strategy, maybe only trading on Thursdays and sticking to your decisions on other days. It's all about more thinking than constant trading for success in the investment game. In a chat with David Rubenstein on Bloomberg Wealth, Howard Marks shared some insights about the changing financial market. He pointed out that higher interest rates are shaking things up, making credit investments more appealing. Marks advised investors to tweak their portfolios by adding more fixed income assets. For instance, let's consider the S&P 500, a stock market index. Back in 1980, it was around 100 points, and now it's at a whopping 4,200 points. To put that in perspective, if you invested just $2 in 1980, that investment would be worth over $80 today. It shows how the market has grown over the years. The S&P 500's explosion can be attributed to the significant profits of the companies within the index. As these companies raked in huge profits, the stock market went up. When interest rates dropped, fixed income securities like government bonds became less attractive. Investors seeking better returns shifted their focus to the stock market. This increased demand for stocks, leading to a willingness among investors to pay higher prices for stocks compared to the 1980s, caused the price to go up. The profitability of companies and changes in interest rates played a crucial role in shaping the movement of the stock market, including the remarkable growth of the S&P 500. Understanding the current market conditions guides you through the twists and turns ahead. When you know what's happening in the market right now, you can make smarter decisions. Markets are dynamic. They can shift due to economic factors, interest rates, or global events. Being aware of these changes allows you to navigate them successfully. Imagine driving a car and adjusting your speed based on road conditions. You wouldn't speed on a slippery road, right? If you understand the current conditions, you can adjust your portfolio accordingly and seize this opportunity. Markets offer opportunities, but they're not constant. Understanding the current conditions helps you identify when to seize those opportunities. Every journey has risks, and the financial market is no different. If you know the current conditions, you will be able to manage risks effectively, and this helps in long-term financial planning. For the past 4 decades, interest rates have been on a downward trend. But now we're entering a phase where interest rates are on the rise. When interest rates rise, it affects both borrowers and asset owners. Borrowing money becomes more expensive for people getting loans for homes or cars, and companies may face higher costs, impacting their profits. The value of existing bonds and stocks can decrease. Additionally, property values might be influenced. As borrowing costs go up, people may cut back on spending, impacting various parts of the economy. So when interest rates increase, it influences how people spend, how businesses operate, and the value of investments. In times of high interest rates, investors should rethink their strategies. With rates up, bonds become appealing for stable returns. It's wise to put more of your investment in bonds for potentially better returns. But watch out for interest rate risk. When rates rise, the value of existing bonds can drop. Managing this risk is crucial to protect your overall investment. Dividend-paying stocks may shine during high rates. Look into companies with a solid history of stable dividends if you're thinking about investing in stocks during these times. The money game is changing, and if things are changing, so should your investment plans. The future might not be like what we're used to, and while we can't predict it, we should know where we stand now. Interest rates took a big dip over the last 40 years, and it's a huge deal in finance. Expect interest rates to be somewhat high, as 2 to 4%, not as low as before. So tweak your investments. Include more fixed income assets in your plan. Instead of just stocks, check out things like corporate loans and high-yield bonds for good returns with less risk than stocks. Regular treasury bills might not be the best during high-interest times, especially for pension funds and endowments. When it comes to investing, Howard offers insights into two main approaches: active and passive investing. Let's break down what these terms mean and how they can shape your investment strategy. Active investing. It involves making decisions to buy or sell assets to outperform the market. It's a hands-on approach where investors actively manage their portfolios, often based on market trends, economic indicators, and individual stock analysis. Howard suggests that active investing requires a deep understanding of the market and a careful, thoughtful approach. It's about making strategic moves based on thorough analysis and staying ahead of market changes. Passive investing, on the other hand, involves a more hands-off approach. Investors typically track a broad market index, like the S&P 500, through instruments like index funds or exchange-traded funds. The goal is to match the overall market performance rather than trying to beat it. While Howard acknowledges the benefits of passive investing, he emphasizes the importance of actively assessing the market's conditions. Even if you choose a passive strategy, staying informed about market trends is crucial. Howard advises investors not to be swayed by social media or large crowds. Acting impulsively based on excitement can be risky, so it's important to stay grounded. You have to proceed with caution, especially in the distressed debt market affected by rising interest rates. Instead of trying to predict the future, investors should adapt to uncertainties and be mindful of the unpredictability of stock prices influenced by people's reactions. Howard warns against the common mistake of believing in the ability to foresee the future, because the reality is that no one truly knows what lies ahead. To make the most of this financial opportunity, consider following these principles. Number 1, understanding how markets work. Investors like Howard Mark, who's an expert, know that markets go through ups and downs. It's hard to predict exactly when these changes will happen. Mark says it's crucial to figure out where we are in the cycle to make smart choices. When everyone is excited, it's a sign to be careful. And when they are worried, it might be an opportunity. Going against the crowd can help investors take advantage of market opportunities. Number 2, managing risk. In the world of investments, risk and reward go hand in hand. According to Howard, understanding and handling risk is important. Risk isn't just about potential loss, but also the uncertainty of what might happen. Recognizing this can change how you approach investments. Luck plays a part in every investment, but real success comes from being skilled at assessing and dealing with risks. Number 3, the core of value investing. Howard follows the value investing approach, which means investing in assets priced lower than their real value. The gap between the price and intrinsic value is a margin of safety, protecting against unexpected challenges. Instead of going after trendy stocks, focus on the asset's quality and its potential for long-term returns. Number 4, handling emotions in investing. Success in the market means controlling your feelings. When the market is good or bad, it's tempting to follow the crowd, but that might not be the best move. Stick to your thoughts, stay updated, and stay true to what you believe is right. Emotions like being too confident, wanting more, or being scared can cause problems, even for experienced investors. Knowing about these challenges helps investors handle the ups and downs of the market better. Number 5, thinking deeply about investments. Howard suggests going beyond the obvious when making investment decisions. Instead of just looking at the surface, think about what might happen next. Investing is not easy, and considering all the details can help you make smarter choices. Number 6, the power of waiting. In the fast investment world, it's crucial to be patient. Quick gains might seem good, but it's often the carefully chosen long-term investments that pay off. Taking a long-term view can help you handle the ups and downs of the market. Just because everyone is busy in the market doesn't mean you have to act right away. Waiting can sometimes be the best move. Howard often talks about being too active, especially when things are uncertain. Number 7, learning and adapting. Markets change, and so should your strategies. What worked in the past might not work now. Stay updated, learn from new situations, and adjust your strategies as things change. Every investor makes mistakes, but being a great investor means learning from those mistakes. Howard often says it's essential to think about what went wrong to be successful in investing. Number 8, the importance of market efficiency. Even though markets are usually efficient, they sometimes get prices wrong. It's important to take advantage of those rare times when the market makes a mistake in pricing. These opportunities, though not common, can lead to big returns if handled correctly. In a time of too much information, Howard supports using information wisely. Not everything out there is useful. Sorting through the noise to find quality data is very important. In an industry where success can be temporary, Howard's lasting principles and teachings ensure you're on the right path to financial success. Whether you're just starting your investment journey or refining your approach, his insights provide timeless guidance in the ever-changing world of finance. Which of these principles stood out for you? Leave a comment below. If you enjoyed this video, like and hit that subscribe button. And thanks for watching.